Infrastructure funds present a distinct monitoring challenge. The assets themselves, toll roads, power plants, airports, data centers, generate operational data that directly affects valuation and investor returns. Middle office teams tracking these investments often find themselves bridging two worlds: the physical performance of long-lived assets and the financial reporting obligations that private fund structures demand. What operational KPIs matter most? Infrastructure assets produce performance metrics tied to their revenue models. The specific KPIs vary by sector, but most fall into three categories. Availability metrics: for assets under availability-based contracts, the percentage of time an asset meets contractual specifications directly determines revenue. A hospital under a PPP arrangement might track availability against a 99% plus threshold. Volume metrics: toll roads, airports, and ports generate revenue based on usage. Traffic counts, passenger throughput, and container volumes become foundational data for financial projections. Operational efficiency: energy assets track capacity factors and heat rates. Utilities monitor grid reliability and outage frequency. How do KPIs connect to fund reporting? Asset-level KPIs inform revenue projections, which flow into discounted cash flow models for fair value estimates under ASC 820 or IFRS 13. A wind farm operating below expected capacity factors may require a valuation adjustment, affecting the fund's NAV. Availability: uptime percentages translate to revenue variance and potential contractual deductions. Volume: traffic and throughput data feed directly into revenue versus budget analysis and DCF model inputs. CapEx: maintenance spend informs cash flow projections and distribution capacity. Regulatory: permit status and compliance events affect risk disclosure and valuation considerations. What compliance items require monitoring? Infrastructure assets operate under permits, concessions, and regulatory frameworks. Common categories include environmental permits, emissions limits, water discharge, waste certifications, safety certifications, inspections for transport infrastructure, fire safety, structural assessments, concession obligations, performance thresholds and project agreements, with cure periods and termination rights. Rate regulation: for regulated utilities, tariff filings, and allowed return calculations. Missing a compliance deadline can trigger events affecting asset value, from fines to concession termination. Most funds maintain compliance calendars with escalation protocols to the GP. How should financial metrics be structured? Infrastructure investments typically produce project-level financials distinct from consolidated fund statements. EBITDA margins, operating performance independent of capital structure. Debt service coverage ratio, critical for project-financed assets with ring-fenced debt cash available for distribution. Amounts available after debt service, CapEx reserves, and working capital CapEx versus budget. Maintenance and growth CapEx with variance analysis. These feed into fund-level metrics: DPI, RVPI, TVPI, and IRR, appearing in quarterly LP reports. Funds with mature monitoring frameworks establish standardized reporting packages collected on a consistent schedule regardless of sector. The operational complexity of infrastructure makes disciplined monitoring essential. Catching deteriorating KPIs early allows for proactive LP communication rather than surprise valuation adjustments at quarter end.